Welcome to Yahoo Finance this Wednesday, May 7th. I'm Julie Hyman alongside Josh Lipton, and we are moments away from the Federal Reserve's decision on interest rates. As we take a look at what's going on in stocks ahead of that decision here, we are seeing the NASDAQ now in the red and stocks overall taking a little bit of a leg lower. The NASDAQ down by about 1/3%. The S&P little change. The Dow is still higher by the 212 points, but as we await the Fed decision today, and it's widely expected they will not change rates today, there is still that acknowledgement that they're in a tough spot.
Yeah, I mean, the bottom line to your point, Julie, is the expectation is that the Fed sits tight, that they remain in kind of wait and see mode, waiting to see how Trump tariffs play out and then decide what best course of action is, the best direction to take is. In the background, of course, all this is President Trump, who has been very vocally and publicly and regularly pressuring Powell to cut. But Powell, at least in recent public appearances, has been signaling that monetary policy is on hold.
Right, and the data for right now supports a still growing economy, shows that inflation has not necessarily picked back up, but there is this broad expectation that it will, at least temporarily, as a result of tariffs. And President Trump just speaking to reporters and seems to be digging in his heels again on the idea of China tariffs, that he's not ready to pull back. That's even as officials from his administration prepared to meet with Chinese counterparts in Switzerland.
Treasury Secretary Bessent on his way.
Exactly.
Yeah.
So there's sort of like a little bit of back and forth in the market over, are we optimistic? Are we pessimistic? And then how that feeds back into the Fed is a big part of the equation. So seeing that little bit of a mixed picture in stocks here as we await not just the Fed decision, but of course the press conference as well. Powell will undoubtedly be asked again about Fed independence and will again really emphasize it. All right, let's go to our Jennifer Schonberger now with that decision.
No change. The Federal Reserve holding rates steady in the range of 4.25% to 4.5% for the third straight meeting, even as President Trump has hammered the central bank to cut rates. Officials say the uncertainty around the economic outlook has increased further, even as they still see the economy having expanded at a solid pace, even as net exports really swung the economic data. Of course, first quarter GDP contracted for the first time in 3 years as importers rushed to import goods ahead of the president's tariffs. Now, officials expressed concern that the risks of higher unemployment and higher inflation have risen. But at the moment, policymakers still judge the labor market to be solid, saying that the unemployment rate has stabilized at a low level in recent months. Officials still see inflation as, quote, somewhat elevated. This decision was unanimous. However, Kansas City Fed President Jeff Schmid was not present for this meeting because of the death of his wife, and in his absence, Minneapolis Fed President Neil Kashkari voted. Guys?
Jennifer, thank you very much. Appreciate it. So not any surprise in terms of the decision to hold rates steady here. And I'm just starting to go through the statement itself to see what have been the changes here from the Federal Reserve. But obviously, the focus continues to be on the dual mandate and where we might start to see changes on those dual parts of the mandate in terms of employment and inflation.
And the truth is, Julie, as we were just talking about, so much of what happens next for the Fed and for the economy, it of course does rest with the president. I mean, what is President Trump's next move? Is he willing to really accept kind of worst case adverse economic scenario? Or is there some type of bright line in the sand where he's not willing to accept that, and then you would see some type of resolution on all the trade and tariff we discussed? That's the background.
Yeah, and we're going to go back to Jen for a moment. Jennifer Schonberger, what else are you noticing here from the statement?
Yeah, Julie, what was interesting to me is the Fed opted to hold rates steady. And the reason for that is they still view the economy and the job market as solid right now, inflation somewhat elevated. It's the risks to the outlook around their dual mandate that lays the question for the policy path forward, right? They see the risks for higher unemployment and for higher inflation now more elevated than they did previously. Uncertainty around the economic outlook has also increased further, but clearly looking at the hard data right now, everything looks okay, thus no move in rates.
Jen, thank you. Appreciate it. For more reaction to the Fed's interest rate decision, we are now bringing in Michael Aroney, Chief Investment Strategist at State Street Global Advisors, and Luke Tilley, Wilmington Trust Chief Economist. and former Philadelphia Fed economic advisor. Welcome to you both. Luke, I will start with you, sir, as the resident economist on the panel. Luke, just your immediate response and reaction to the Fed's decision here, Luke.
Yeah, I think the decision is as expected. No movement in rates, of course, and then also acknowledging the risks for higher employment and higher inflation. And it's not that much of a surprise on the day, but I think if we look back to January 1 of the year, the biggest change has been from, at that point, a lot of people were just viewing tariffs as having this upside inflation risk and that the Fed might even have to hike. But as we've gone through the first 4 months of the year and seen that consumers are not nearly as strong as that common narrative on January 1, that it really poses a risk to growth. So I think at the beginning of the year, people were much more worried about the Fed needing to hike because of those inflation pressures. But now it's clear that there's a little bit of a tug of war going on here between the risk of higher inflation and weaker growth. We think that weaker growth would ultimately win out, that would be the stronger force. There might be some higher prices in the near term, but this is likely to cause a recession if tariffs stay as they are. And we think the Fed would end up cutting later this year, even if they're not communicating that now.
Michael Roney, I want to bring you into this as well. To me, this statement stands out. This line stands out from the statement. Uncertainty about the economic outlook has increased further. Not that that is news to any of us, right? I'm sure you've been listening to a lot of conference calls this earnings season, and uncertainty remains the word of the day. But if uncertainty is the word of the day, how does the Fed do its job? How do you all do your jobs in terms of figuring out how to manage portfolios?
So, Julie, I think there is a small window of opportunity on a number of fronts. One is monetary policy, and to begin to ease monetary policy in advance of what could be a difficult summer and third quarter. Yet the Fed has chosen today to at least take a pass on that. Certainly the second component of this is if the Trump administration continues to pursue aggressively deregulation, the tax bill, and other pro-growth policies. That's ongoing, but will take a while. Certainly you have the tariff and trade negotiations, but boy, there seems to be a lot of back and forth on this, and the window is closing. And then finally, earnings, they are good. And maybe through the continuation of a decent earnings environment, you might be able to kind of avoid recession. But I guess the message I'm trying to deliver here is that this window is getting smaller and smaller. And soon the hard data will confirm what we already see in the soft data. Hasn't yet, but that's the fear.
Luke, bring you back in here. Jay Powell's presser starting shortly. Luke, if you had the chance to ask him a question or two, Luke, what would be top of mind?
Yeah, top of my mind would definitely be the labor market. It seems like a lot of people are taking some solace or comfort in that hard data with the jobs report. But the reference week for the most recent jobs report was April 6th to April 12th. So that's just really the week immediately following the Rose Garden announcements. And that's the number of people who were on payrolls at that time. They likely worked the previous week and that week to be paid. They probably took those jobs at the end of March. So we really haven't seen any impact at all from tariffs, and we should not have expected it to see in this most recent report. It would be in the upcoming reports. So I think the question that's most important is how the Fed is thinking about that, the timing of that report, the risks to the labor market. And then also so many Fed officials have said, basically we'll start cutting when we see the labor market weaken. However, we know that from history from previous recessions that the labor market is a lagging indicator. It's the economy that turns first and then the labor market turns later. So I'd want to hear what they're thinking about that.
Well, and I'm curious what other numbers that you're watching, Luke, as an economist here. I mean, if you look at as part of the JOLTS report, we're not necessarily seeing cuts go up, but we are seeing hiring rates start to go down and quits rates are going down as well. So when you're looking at that kind of data, or are there other sort of high frequency, unorthodox data that you're trying to turn to try to figure out what's going on here?
Yeah, the JOLTS data is incredibly delayed. It's always a month behind the actual non-farm numbers. The alternative data sources like LinkUp and Indeed showed that there were a big drop in job openings immediately after the Rose Garden announcements. So we would expect to see labor demand falling off. And even if you didn't see people pulling those postings, what we hear from company surveys and talking to our companies, our clients and customers, is that they're holding off on making an actual hire. Even if they don't pull that job opening, a lot of nerves right now about making a hire because it's really expensive to hire people. It's really expensive to fire people. So we see people sitting back on CapEx and on hiring, and that's going to end up having an impact. Like the other guest said, the window is really closing here because companies are already reacting now.
Michael, I'll bring you back as well. I know you argue, Michael, to your clients, listen, the easy gains you say are over, market volatility, that's going to remain elevated. Against this backdrop we find ourselves in, Michael, when your clients come to you, they ask you, okay, bottom line, how should I be positioned right now in the market? What are you telling them?
So Josh, first and foremost, I think it's not to overreact. So we always encourage investors, you have a long time horizon. In most instances, diversification's your friend. Discipline's important, and when you feel anxious, you feel like you won't need to do something, it's often to take a deep breath and rely on that. But we are encouraging investors to begin to revisit things like safe havens, defensive sectors of the market like healthcare, for example. Dividend payers and growers have held up much better than the broader market so far this year in this volatility. Services companies relative to goods, so those companies are less impacted by tariffs. We've seen bonds and stocks go down together. So looking at some of the alternative investments that may have a low correlation. And if you haven't owned international in a long time, or you're underweight relative to your global benchmark, it's probably time to start buying some international stocks and getting closer to your benchmark weight from that perspective. So those are 5 or 6 things that we're encouraging investors to revisit given the uncertainty.
So it's interesting because a lot of those things have had moves already. Like gold, for example, has had obviously really good gains. International has had some good gains, but it sounds like you don't think that those moves are necessarily over here.
I still think that we have a degree of uncertainty that will remain with us for a while. I think that headline risk remains high, and I think the risks are skewed to the downside. As I said, there are a number of off-ramps. We all like to use that term when we talk about the Trump administration and the potential for these off-ramps. But so far, we haven't seen them. And I think Luke mentioned this, I mentioned it, this window is closing. In the middle of June, this data, this soft data, or these surveys that we're seeing are going to start being reflected in hard data. Earnings are already coming down. And I think that at that point, you may have missed that opportunity. So given those things, we think kind of revisiting the safe havens, the dividend payers and growers, the defensives, all those things are probably the prudent thing to do, at least for now.
Michael, Luke, thank you so much. We're going to hear from you again after the Powell press conference. So stick around. Looking forward to catching up with you after we get that color. Well, for more on how markets are reacting to the news, let's get to Yahoo Finance's Alexandra Canal. Allie, what are we seeing?
Hey, Julie. Yeah, we're seeing a little bit of pressure. No crazy moves here, but you're looking at the benchmark S&P 500 flipping into negative territory. 2 p.m., right around when that decision was released. You also see the Dow off some of those earlier highs. We are barely trading in the green, up about 0.1%. And the NASDAQ composite is down about 0.9%. Now, as we've been noting, this decision was expected. However, I think the risks of higher unemployment that the Fed laid out, along with higher inflation, that is tilted to the upside. That might be a little bit of pause for investors. Also, uncertainty about the outlook has increased further as the Fed really tries to wade through a lot of these tariff updates and that Trump uncertainty. I want to take a look at Treasury yields. We are seeing yields moving lower on the 10-year. We're only down about 3 basis points. That was pretty much little change from that announcement that we got at 2 p.m. If we look over the past 2 months, we've seen this up and down ride with yields. We saw a surge shortly following that Liberation Day announcement. That's when we first heard about Trump's tariff plans. We have leveled out, though. We're now trading around 4.3%. Let's also take a look at Bitcoin because it's been pretty risk on right now. We are up 10% over the past 2 months. Today, we are up a more modest 1.4%, trading just below $96,000 a coin. Speaking of risk on, let's see how the NASDAQ tech is doing. Alphabet really dragging down the overall NASDAQ here. Nvidia is down about 1%, little change for a name like Microsoft. And then quickly flipping over to some of the sector action to see what's leading here. We have healthcare in the green along with financials, and then you have communication services, materials leading the way lower here. So we will continue to monitor this. And then, of course, Jerome Powell speaking at 2:30 p.m. Markets will certainly be reacting to that.
Indeed, they will. Thanks, Sally. Appreciate it. Stick around. We're going to continue to break down the latest decision by the Fed and also get you set for Jay Powell's press conference. More of Yahoo Finance's special coverage of Fed Day still to come. The Federal Reserve leaving interest rates unchanged for a third meeting in a row. That move defying President Trump's calls for the central bank to loosen monetary policy. Vishal Kanduja, Morgan Stanley Senior Fixed Income Portfolio Manager, joining us now to discuss. Vishal, so we got this hold as expected. We got an uptick in concern about stagflation, sort of expressed in the statement here. At the same time, markets are moving on the Fed. They also appear to be moving on some commentary from President Trump that he's not going to preemptively lower tariffs to get Chinese negotiators to the table. When you put all that together, what does it mean for fixed income markets?
Sure, thanks, and good afternoon. I think this statement did exactly what the Fed wanted it to do, is just stay the course, repeat their concern for more growth downsides, concern about their dual mandate at risk and uncertainty increasing on that part, but then no action. So I think that extra word, as you pointed out, the further, that was added in one statement, and then the extra layer of uncertainty to their dual mandate, that did the trick. Now, I'm hoping that Jerome Powell repeats that performance of the statement in his Q&A as well. What does this do for the fixed income markets? I think some of the things that I think we've been looking for is the monetary policy's reaction function to all of this. Are they still focused on growth downsides versus inflation upsides? I think Q&A will be focused a lot more on that. I think the market could get a little disappointed if they're trying to eke out a statement or two or reaction function if they're going to see through some of the high inflation prints starting next week. So I think front end of the market should be pretty well bid. The 0 to 5 year anchors down. The back end of the market, I know it's putting up a great performance today, but it's still vulnerable to what's happening in DC from the deficit reduction plan or lack thereof, if you will.
So that benchmark 10-year, Vishal, lots of puts and takes there, but so we're sitting here at 4.26. When your clients ask you, Vishal, where you think that's headed, near, intermediate term, you tell them what?
I think initially around October, November, we were looking at the economy, looking at the strengths of consumer and corporate balance sheets, even though uncertainty was high and volatility was going to be high, but our range was 4 to 5%. Very difficult to breach the 4% as we thought that nominal growth will keep up, and then very difficult to breach the 5 as that's where we think that stalls the economy down. We've seen that in Q1 of 2023 as well with the regional bank crisis here. Now I think our range is more 350 to 450 on that end. So that's why, because the nominal growth picture has changed. We do think that there's going to be a clear demand destruction in the back half of this year. And the next 18 months, I think the Fed will be dovish and will use some of that tools in the toolkit to keep up with their dual mandate.
Vishal, as we mentioned, President Trump has continued to discuss the Fed and has continued to discuss Jay Powell. From a market participant's perspective, what does that mean in terms of, I guess, the predictability for what the Fed's going to be doing?
I think the makeup of the Fed today, with Jerome Powell at the head of it, is pretty strong. We do think that they have quite a bit of independence, and they're going to assert their independence throughout this process as well. They did it last year during the election time frame. I know there was quite a bit of chatter about the Fed's independence at that point. They got us through that, the weak unemployment reports that we had started to see, 100 basis points in 3 meetings, and they are going to, we strongly believe, get us through this part of the uncertainty as well. But yes, I think the tweet or the post that we had seen on Truth Social, I think in our minds starts the interview process, which hopefully in our minds as a base case ends up in May 2026 when the current chairman's term is done. So independence is definitely at risk, but we do think our base case is that they'll be able to assert themselves through the economic cycle here.
And Vishal, those very smart economists you work with over there at Morgan Stanley, how many cuts, Vishal, are they estimating and expecting in 2025?
I think less so in the summer. It'll be more in the back half. I think that's why if you look at our conviction level on exactly when they start to cut here, is lower. That's why we don't have very big magnitude of bets in the 0 to 1 year part of the curve. But then as you gradually move away and move into that sort of 12 to 18 month time frame, we think our conviction level is pretty high that they will be dovish, about 4 to 5 cuts in the next 12 to 18 months. And that's why our sort of overweight to the Treasury curve or interest rate curve is more in that 5-year mark, to be clear on the positioning.
So you think that's the part of the curve that is going to benefit the most if they are cutting more?
Exactly. I think that terminal rate sensitivity to that 5-year point of the curve, as well as if I take a step back, what are we trying to achieve with a fixed income allocation? There's a dual mandate. We're trying to get income and total return, and we're trying to get your negative correlation to risky assets. And we think that 5-year point, 3 to 5 year point, to be very clear, is that sort of opportune or a point to express that opinion with. And then the more you move on to sort of like expand that out, the same analysis to the back end of the yield curve, and a few more sort of variables start affecting that. I think lack of a credible, sustainable deficit reduction plan. You start getting into the demand and supply. You start getting into some of the reserve currency issue, et cetera. That 20 and 30 year part of the curve, in our opinion, is very vulnerable to that. And that's what is going to be very reflective, or the term premium is going to be very reflective of that opinion from the market.
Vishal, I'm curious, when you're talking to those Morgan Stanley clients right now, what is top of mind? What are the questions you're getting the most?
I think the biggest question that we are getting today is is Treasury a safe haven, or U.S. Treasury? And then the byproduct of that line of questioning goes on to the dollar. And then, as you can imagine, I think the byproduct of all that line of questioning goes into what is that ultimate plan from the tariff and the negotiations that we're going through at this point. And our answer to that one is very, very clear. I think you look at the entire month of April, bonds actually delivered. The 0 to 10 year part of the curve did deliver on its dual mandate, did deliver on that safe haven. I know there were like 2 trading sessions where we tested it very clearly from a liquidity standpoint. But overall, we do think that continues on even in the next 12 to 18 months as the uncertainty from the economic standpoint picks up. Dollar, we do think it weakens. We have enjoyed, yes, I can go back 2 decades, but even if you look back in the last 5 years, an over allocation to US dollar-based assets. So as a global asset allocator, you're looking at relative value in other parts of the economy, and you're looking or in the globe, and you are finding a few more, little bit more certain outcomes from an economic standpoint. You're finding a few more currencies that you could allocate to. So yes, I think their over allocation that US dollar had enjoyed probably is going to be less so, but we don't think that this is going to be a complete running away from everything that is US dollar based.
Vishal, great to see you and to have you on the show. Thank you, sir.
Thank you.
For more on the Fed's latest decision on rate cuts and the path ahead, let's welcome in now Esther George, former Federal Reserve Bank of Kansas City CEO and President. Esther, great to see you. So we have the Fed decision. Esther, curious to get your response. Was it the right decision, Esther?
Well, it feels like the right decision to me, and I think it is completely consistent with how the Fed has been talking about the risk that they face right now. So holding on that interest rate seems not only expected, but I think appropriate at this stage.
And Esther, one of the interesting through lines has been the patience that the Fed is bringing to this process. But of course, the conditions in the economy have allowed them to be patient, have they not? What would have to change, and how significantly, for a little more urgency to come into the fore here?
Well, I think you're exactly right. And remember, the playbook the Fed has seen before in this realm came in 2019, when tariffs were also the narrative at the time. And what has changed, of course, is that at that time, the Fed was not struggling with inflation. We were operating with inflation below the Fed's target. And so the ability to take a risk management approach allowed the Fed to be preemptive, if you will. That is certainly not the case today. And I think the amount of uncertainty is greater. Certainly the magnitude of the tariffs being considered a lot more dramatic. So it gives the Fed much less flexibility in looking ahead to an outlook or a forecast. They really have to watch the data right now.
And I'm curious, Esther, what's the economic data you're watching most closely right now? What's on your screen?
So, the thing that I spent a lot of time with as a Fed president and continue to watch today is what do you hear in real time from businesses, from people that are actually making decisions in the economy? And I think the Federal Reserve's Beige Book gave you some clues to that. Some parts of the economy doing okay, others being very concerned. And so I think right now that uncertainty has permeated every contact that I talk to and is causing them to really step back and pause on any decisions about investment, spending, or even households thinking about purchases they might be wanting to make.
Esther, of course, we have to ask you about Fed independence, too. Jay Powell has been very firm in his stance that the Fed is an independent organization, of course. President Trump has kept up his rhetoric. I guess at what point, though, how does the Fed be careful to not be pushing too hard against what the president wants because of wanting that appearance of remaining independent?
Yeah, it's one of the most important issues, I think, right now, Julie, is that I'm not concerned that in their deliberations, they are wrestling with this issue of independence. They are really focused on what allows them to achieve their mandate in a way that benefits the public interest. But of course, when this criticism is very public, they are quite aware that in their communications and in their rationale for actions they take, it will readily be viewed through the lens of some of these criticisms. So I think it just adds a layer of complexity to the very hard work they already have to do. It certainly, I think, with this current set of governors and Fed presidents is not going to sway, though, their decision on what is right for the economy in their judgment.
Esther, I'm curious for you. I mean, how many cuts would you expect in 2025? And what do you think the timeline could be?
I think prior to April 2nd, it seemed that if inflation was going to cooperate, you would have the ability to move those rates down a bit more. But I think in today's setting, we're going to have to see a few more months to know whether the anticipated weakening is severe enough to calibrate 2, 3, 4 cuts, or whether the economy, in what we traditionally call a stagflationary sense, is able to continue to grow slowly, keep the unemployment rate at a level that allows the Fed to calibrate those in a smoother fashion. And so there is so much yet to see in the data that I think will help inform the Fed's decision. And of course, you see that in their statement today. Their statement highlights both of those issues, employment and inflation, as being their big risk. Employment to the upside and inflation continuing to be an issue.
Do you think that it's also still too early to call whether there is going to be a recession as a result of all of this?
I do. And the reason I think so is because although there are clearly signs of weakening, the magnitude of that weakening will be very important to understand where it hits the economy. And so right now, I think the Fed has to be less forecast dependent, as some call it, and be more data dependent to see how this begins to unfold and what the magnitude of this weakness ultimately is.
Esther George, always great to catch up with you. Thank you so much.
Thank you.
We are awaiting the beginning of Federal Reserve Chair Jay Powell's press conference in just a few moments. Ahead of that, we're seeing a more mixed picture in markets than we were earlier. Earlier, it was just the NASDAQ that was trading lower. Now the S&P 500 has dipped into the red as well, and the NASDAQ has, we've seen it come down from some of its earlier, or I should say the Dow has come down from some of its earlier gains, Josh, sort of in reaction to this, and it also seems perhaps to some of President Trump's comments as well.
Yeah, and so now we do turn to that presser. I would assume, Julie, we're going to hear Jay Powell use the word uncertain a lot, I would think. A lot of uncertainty out there, uncertain about the Trump tariffs and their effects and impacts, sort of then making the case about why the Fed needs to stand pat for now. Interesting comment, by the way, from Peter Bukvar, economist and strategist, friend of ours, just writing his clients here. He says the bottom line, the stagflationary risk highlighted by the FOMC is a handcuff-type acknowledgement that freezes them for now until they get more details on what the tariff regime globally will look like in coming months and quarters.
Right, exactly. I mean, the other question is, you know, when we talk about the reaction function, we also talk about how Fed rate cuts move through the economy. Even if we were slowing in this economic environment, if they cut, what would it achieve, I think is a question to ask. All right, here is Fed Chair Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. the effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmeros for the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, Housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by about where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops. And I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking we never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive, because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
You know, so first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, you know, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time. So, again, difficult judgment to make, and not one that we face today, and we may never face it, but you know, we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen. but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not on your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene. Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses, big and small, are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen. 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we have the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path, and it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point, and it was click, 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 click each month, and everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market, and so at Jackson Hole, and then in September, we wanted to address that forthrightly. We wanted to show that we were there for we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Hey. Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. But what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly? I
don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. the volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decisions. So the volume of the imports, imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is, we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses, and so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting, and so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. you're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you were monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else, and right now we see inflation kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not. I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
That was Federal Reserve Chair Jerome Powell speaking following the latest decision by the FOMC and ending dramatically. In answer to a question from our Jennifer Schonberger, he said, "I have never asked for a meeting with any president, and I never will." Can't imagine myself doing that, he said. And this, of course, part of the ongoing narrative and questions about the Fed's independence, and continued his strong line, really emphasizing that the Fed is an independent body.
Yeah, on Trump, he was asked about the pressure from the president on the Fed to cut, and Powell saying it does not affect doing our job at all. I have not seen Trump weigh in on Truth Social yet, but the day is young, Julie. Bottom line, we listened to the presser. In terms of what he sees now, it was constructive, right? He said an economy that's resilient, a labor market that's resilient. He talked about how underlying inflation looks good. But then clearly uncertainty, that was a theme of this conference, right? And certainly about the size, scale, persistence of the tariffs, as he put it. So that's why he emphasized he believes it was prudent for them to take this wait-and-see approach. I mean, really, he said it in a lot of different ways, Julie, but that was the theme. There's just a ton of uncertainty around trade policy and tariffs, and they're going to sit tight.
Right, and to the point where he isn't willing to weigh in on which part of the mandate is going to need attention first. In other words, is inflation going to be more of a problem? Is growth going to be more of a problem in employment? He doesn't know. He's not willing to talk about that. And so the other theme is, again, that they, and this is a theme that is not new to this press conference, they have the time, right? Because the economy right now is on relatively solid footing, they have the luxury of waiting. And he also said they weren't going to be preemptive in their moves. They were going to wait to see what the data shows and then move as a result.
And to your point, that was actually the very first question of the conference. Any closer to which side of the mandate will need urgent care first, as the reporter put it. And Powell saying the risks have risen for both. How it shakes out, he said, again, that word uncertainty, but he emphasized, and this was another thing, policy rate in a good place as he awaits data and clarity.
Yeah, and as we look at the markets in the wake of the press conference here, not seeing a big difference where we were before. I mean, we did see the S&P slip into the red a little bit. Now it is back higher, but really a pretty narrow range and not much change overall. The Dow near its highs of the session. I believe stocks overall near their highs of the session, but still not huge moves that we are seeing.
All right, well, Fed Chair Jerome Powell wrapping up a press conference, the Fed leaving interest rates unchanged in May. For more reaction, we're going to bring in Michael Aroney, Chief Investment Strategist at State Street Global Advisors, and Luke Tilley, Wilmington Trust Chief Economist and former Philadelphia Fed Economic Advisor. Luke, I'll start with you. Jay Powell has spoken. Luke, you were listening. What'd you make of it? What'd you learn?
He was talking pretty much in the way that we would expect, I think. You know, the statement said it clear, as we talked about a little bit over an hour ago, and that uncertainty has really increased on both the growth and the inflation side, and they seem very comfortable with their ability to react depending on which way it goes. And I think he was really trying to straddle the line and not show a tendency to go either direction. I think one of the more interesting things to me is that it sounded like, when given the opportunity, he did not take the next meeting off the table for action, for a cut. So at the previous meeting 7 weeks ago, when he was asked, is the May meeting, is today's meeting a possibility, he was pretty forceful and said, we are not in a hurry. And given a similar question today about whether action could be taken at the next meeting, he wasn't as forceful. He wasn't trying to communicate any kind of certainty there. And they're never going to say point blank that a meeting is off the table. But he sort of made it sound like it was possible. And I think that they're bracing themselves for what could be a pretty quick change when we see the tariffs flow through to activity and to labor market data.
Michael, if we do see the Fed that happening, that quick change in data, I guess I would ask, first of all, do you expect that to happen? And do you expect the Fed to be, if it does cut rates, how much is that actually going to help? I mean, I know you're more on the investor side than the economist side, but I'm curious to get your take.
So I don't think that the Fed will aggressively cut rates. It seems like it'll be a methodical approach to this. And I don't think that the data will change all that much between now and the next meeting. I think Chairman Powell kind of addressed that. Now, personally, I have two bones to pick with Chairman Powell. First, in November, he said that the Fed doesn't guess, doesn't speculate or assume. But yet when it comes to tariffs, that's exactly what they're doing. They're assuming that tariffs are inflationary. And in fact, that wasn't the case in 2018. They were not inflationary. And we all talk about this notion that tariffs are a tax, and taxes reduce economic growth. And so for me, I think there's this kind of misplaced fear that inflation will be rising. The second part of this is I disagree with this notion that we're in a good place already and we have time to wait. It's almost as if we're waiting for the accident to happen before we react. And that's what I'm most concerned about. So at 4.25 and 4.5, and your core inflation measure at 2.6, you already have the opportunity to cut rates 3 to 4 times, 25 basis points each, and still be 1% above your preferred measure of inflation. So to me, I think the Fed is too tight. So those are my two big bones to pick with the Fed and my two big concerns here in the next kind of few meetings.
So Mike, let's just put a fine point on this. So you think the Fed is too late, and you are much more concerned about growth.
Absolutely. I think that the inflation fears are misplaced. I think inflation's cooling. I have the PCE numbers here in front of me. So it was 2.9 in December, 2.7 in January. Certainly we had a little bit of a hiccup in February. It was 3.0. This is core PCE, what we all claim is the Fed's preferred measure. We're at 2.6, and we had a 0.0 month over month in the most recent month. So the fears, and somebody asked him this during the press conference, the fears are that it's tariffs that will result in an uptick in inflation. There's no other data that suggests that this inflation will tick up other than that. And I just disagree that tariffs will be inflationary. In fact, I think that that's a mistake. It's a mistake they made in 2018. So the Fed never hurries until it's too late, and then they have to catch up. And I'm afraid that that might be the case this time around as well.
Luke, let's bringing you back in here. Do you you've been listening there. Do you share Michael's views and broad concerns there?
Well, I certainly don't think that inflation is a problem. Total PCE down to 2.3%. When you remove the shelter component, which we know has this weird lag that takes a long time to catch up, but the entire PCE minus shelter, the Fed's already been at their target for 12 months. And like Michael, I don't think that there's any threat of it advancing higher. I don't think consumers are in a strong enough place to push inflation higher. I understand why the Fed would be guarding against the upside. If they don't want to make that mistake twice. And then the other thing is, if they're late by one meeting or two meetings, there's not a whole lot that 25 basis points or 50 basis points is going to do to help the economy over the course of 7 or 14 weeks, because the recession that we think we're heading into has to do with a very large tax. It's 2.6% of GDP, $780 billion based on 2024 trade. And there's not really anything that the Fed can do to stop that from happening. And if we persist with the tariffs, even if they're 10% on all countries and 25% on China, and we're trying to move things domestic production, well, that's a huge, huge investment move that needs to happen, and it's going to cause a slowdown and sort of a hiccup, and there's nothing the Fed can do about that. So I agree with Michael's assessment that inflation is not a problem and the Fed is going to end up cutting. I don't think that 7 or 14 weeks is going to make much of a difference at all. So that's what I think will end up happening.
Well, Luke, just to drill down into this a little bit for viewers who, it's sometimes hard to understand how exactly the Fed's moves make their way through the economy, right? Which is kind of what you were just talking about. So let's say growth is already slowing. Maybe it's too late. Maybe it's not. When they cut rates, how does that make its way through in this particular moment and environment where tariffs are high and people are concerned? What then does that cutting of rates do for the economy, and on what timetable?
Yeah, they could have a material impact on interest rates. It's more about how they talk about it once they do start cutting, or even beforehand. Everybody gets all over the Fed for not raising rates when inflation had come up in 2021 and 2022, and they didn't hike until March of 23. But they had started talking about it in November, 5 months earlier, and they were able to basically double the 2-year Treasury yield over the course of 5 months before they ever took any action. So when they do get to the point of cutting rates, which is what I think will end up happening, they'll also be talking about how more cuts are likely on the way, that methodical approach that Michael mentioned here. And you would see 2-year yields moving down. That would be somewhat supportive of equities. I don't think it could stave off a recession, because we're still talking about a huge, huge tariff tax hike and a big repositioning by companies. But it would be helpful, and you would see it push through. If they are communicating about it and communicating that there are more rate cuts coming, you would see it play out in the 12 and 24-month yields, and you'd get some monetary easing there.
Michael, last one to you. The theme of the presser was uncertainty, and Powell came back to that again and again, and needs more clarity and needs more data. I'm just curious for you, Michael, as a strategist, and you're watching the economic data very closely. What's the data on your radar, Michael? What are you watching most closely right now?
So I think there's 3 things to keep an eye on. I think jobless claims is an important leading indicator of the labor market. So Powell went out of his way to continue to suggest that the labor market's been resilient and in good shape. So if we start to see layoffs increase, that'll be an important indicator that something's gone wrong in the labor market. And that certainly feeds through to consumption. The second is credit spreads. So we know that high yield spreads relative to treasuries did widen as market volatility picked up post-Liberation Day. They're back to historically tight levels. So we know that we don't really have economic cycles anymore. We have credit cycles. And ultimately, the credit markets are suggesting a fairly benign environment for the economy, which is a good sign, a very positive sign. And thirdly, earnings. And so I know that this one's a little difficult because there's some rear view mirror component to this, but company earnings continue to be quite strong. So year over year, it looks like S&P 500 company earnings are going to grow by about 13%. That's coming off a previous quarter that grew by double digits. And it looks like earnings, although they're coming down some, which typically happens, will be very strong this year. As long as that's the case, those three things indicate to me that the labor market and consumers in good shape, the credit market's in good shape, and ultimately businesses are in good shape. Those are the three things I'm keeping an eye on.
All right, we'll watch them too, Mike. Thank you so much, Michael and Luke. Good to catch up with you, and thanks for sticking around until after the presser. Appreciate it. The Federal Reserve holding rates steady while Fed Chair Jay Powell points to the possibility of a rate cut in September. Let's get to Yahoo Finance's Jennifer Schonberger with the details. Jen, gotta say, that answer that you got out of him at the end was a highlight for me.
Oh, thank you so much, Julie. I would say the number one phrase, if we were to take one away from this press conference, is that policy is in a good place, right? In the face of all this uncertainty, that was also maybe a buzzword for this press conference. But Fed Chair Powell very much stressing that given that the economy is in solid shape, even as they see risks rising for both unemployment and inflation, the Fed doesn't see any downside costs to waiting to see which path would be appropriate when it comes to policy. When the Fed chair was asked whether we could see any change in policy as soon as the next meeting, listen to what he had to say.
We feel like it's appropriate to be patient. And, when things develop, of course, we have a record of, we can move quickly when that's appropriate. But we think right now, the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out.
Now, if tariffs were to remain in place, and Powell stressed there is a lot of uncertainty about that, certainly there are negotiations with China that are expected to kick off this weekend, but if they were to remain in place, then he says the Fed would anticipate higher inflation, higher unemployment, and lower growth. He says that right now, both sides of the dual mandate are not conflicting with each other, though it will depend as things unfold how all of that could shake out, whether they're farther on their unemployment side of the mandate or farther on the inflation side of the mandate. Now, he also did address the notion of preemptive cuts, something that President Trump has been calling for. He underscored that the 3 cuts that the Fed did last fall were not considered preemptive, and that we're not in a situation where the Fed could actually execute preemptive cuts because it's unclear which direction the economy and inflation are going to go in. He talked about the prospect of expectation for higher inflation, certainly in the short term, if not in the long term, depending how these tariffs play out. And so he says, with that also with the backdrop of a weakening economy, it's just not a situation where you could do preemptive cuts. As for what the Fed would look for when it comes to cutting rates and a deterioration in the job market, he says it will be the level of speed with which the unemployment rate increases, but also just looking at the totality of the data. And guys, I did ask the Fed chair why he hasn't requested a meeting with President Trump this year. So far, no meetings have been revealed on his schedule. Listen to what he had to say.
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And we'll await whether we see a response from 1600 Pennsylvania Avenue. Back to you.
Or from our screens, most likely, or via our screens, we should say. Jen Schonberger, thank you so much. Appreciate it.
Thank you.
That concludes our Fed Day coverage. Market domination begins on the other side. and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We got under 30 minutes to go until the market closed. So let's take a look at the major averages in the wake of the Fed's hold on interest rates and the press conference. Got a lot of volatility going on here today in the Dow. I mean, it's a pretty tight range that we see right now, up almost 200 points, but nonetheless interesting to see all that bouncing around. The S&P 500, similar story, very little change when all is said and done. The Nasdaq down a little bit, and the market reacting not just to the Fed but also reacting to tariff headlines throughout the day as sort of that continues. Just want to check on the 10-year as well, where we're seeing a little bit of a slide in yields.
Yeah, overall in that press, Powell, when he told you what he sees right now, economy resilient, labor market resilient, underlying inflation, he says looks good, but clearly the theme was uncertainty. Powell was saying it in a lot of different ways, but the theme was, listen, uncertainty around the trade and tariffs, and we here at the Fed, we just need more clarity.
Yes.
We need more data. President Trump, I have not seen him weigh in yet. Who knows? He did, though, to your point, make some headlines on trade when he said, listen, I'm not lowering China tariffs to jumpstart those talks.
Right, exactly. Yeah. But the talks are happening anyway. So
that's an off to Switzerland.
Exactly.
Right.
So let's take a look at some of the other movement that we're seeing in the markets here. We've got the sectors here: materials and communication services, the worst; healthcare, the best here. We heard Michael Aroney of State Street earlier talking about the need to tilt a little defensive. Healthcare is one of the areas he mentioned. And then there's what we're seeing in big cap tech today. Which one of these things stands out to you on this big screen? We're going to talk more about it in a moment, but Alphabet shares tumbling today.
Big, unusual move.
It is a big, unusual move. It's down 8%, and it has to do with some comments from the Hill today. So let's dig into that.
Which we'll get to. Apple's Senior Vice President of Services, that would be Eddie Q, reportedly revealing today that Apple's exploring adding AI search engines to its default Safari web browser. Shares of Alphabet taking a hit on the report, and Yahoo Finance's Dan Howley is here with more. Dan.
That's right. This is from Eddie Q. This is from the antitrust trial that's going on with regards to Google's search monopoly that they've been found guilty of having. And so Eddie Q is there. Google and Apple have a $20 billion deal where Google is the default search engine for the Safari browser and other things throughout Apple's ecosystem. At $20 billion a year goes into Apple's services. It's a large chunk of change for Apple. Just to give you context, in 2024, services brought in $96.1 billion. So $20 billion of that seemingly comes from the Google deal. But for Google, it's an even bigger issue because Q had also said that in April was the first time that the company had seen a decline in searches on Safari, and so that would seemingly translate to a decline in Google searches for the first time on their platform. And so he mentions how they want to keep using Google search. They don't want to get rid of it as the default because of that deal, but that Apple is exploring adding different generative AI search options, and some of the ones that come to mind, obviously, they do have a deal with ChatGPT already as part of the Apple Intelligence Platform, OpenAI, but they could also look at stuff like Perplexity, which is another generative AI search engine. And so this kind of coming together at a time when Google's entire kind of empire is facing threats from the search side to the ads side, and then this discussion of this drop in traffic really leads you to believe that perhaps there's more going on behind the scenes with Google than we've previously thought, or it could just be that we're starting to see that shift for people going over to the kind of generative AI search that has really come forward, and it's the reason why ChatGPT shot up so quickly. When it was first introduced. People are interested in this technology. There are other options out there. OpenAI has ChatGPT search. Perplexity is another option. Google does have its own generative AI search, by the way. It's AI overviews. They also have an AI mode that's more akin to what you would get from GPT search. Microsoft also has something along those lines with its Copilot search. But I think obviously ChatGPT, they got out there with first mover advantage. Perplexity is building up over time. And so it really does stand to reason that they could become major threats to Google's biggest product, which is search.
It's amazing, Dan, because if this wasn't a Fed day, I think this story would be getting even more attention. I mean, the move in Alphabet today, that's a huge move for that company and unusual. And when you have, according to these reports, Apple's Eddie Q, Apple's head of services, longtime Apple veteran, is saying searches on Safari dipped for the first time last month. And apparently he attributes that to people using AI, and that he thinks AI search providers, the OpenAIs, the Perplexities, the Anthropics, they're going to at some point replace standard search engines like Google. I mean, this is something we've talked a lot about. This this has been the big existential worry for Google, that AI is going to come here and just upend and redefine Google's bread and butter. And I feel like investors, they saw these headlines today from Eddie Q, and I think a lot of investors seem to think like, whoa, that is a big data point from a big important source.
And can I just say, at the same time that the government is trying to get Google to separate its businesses, right? And so if it's not going to have the other stuff, and is just going to have to rely on the search business, and the search business is in secular decline, or listen, this is a leap, right? It's not yet.
Yeah.
But that's, that's.
What did you make, Dan? I thought this was interesting. Here was a Gene Munster, longtime tech analyst. Here's what he wrote on X. He said, the bull case now depends on convincing yourself that despite everything we've seen and heard from Eddie Q, Google is suddenly going to flip a switch and figure out how to solve for a world beyond 10 blue links.
It's interesting because when you look at Google's AI mode, which they're still in testing, there are no blue links. It's no longer that list. It's similar to the Anthropics, that chat interface that you see on these different search products. And so there are bits of what you would recognize from Google, some pop-ups for if you look for a restaurant, it'll show you the location in Google Maps on the side and some reviews, but it carries over that kind of, here's my question, here's the response from the chat. That's obviously not the main search right now. It's still very much in testing. You need to opt into it. So it's not as though that's taking over yet. And again, they still have AI overviews. I'm looking at a quick reaction from Justin Patterson from KeyBank saying that search volumes being pressured, it's not necessarily new information, but I think the market reaction is really about this Google-Apple relationship. And then if people are moving over to these other options, then what does that mean for Google's long-term sustainability? And so it's also worth noting that there's still trillions of searches on Google every year. It's not going away anytime soon. There's a reason why we Google things, right? And
the bulls would say, Dan, Google, listen, they've got the infrastructure, the data analytics, the ad tech, no easy things to quickly mimic.
But I think there's been this narrative that Google's search is no longer what it once was, right? Like it's not giving you exactly what you want, and so I think that maybe you have that narrative going. You have these new entrants. It's kind of the basically a perfect storm of kind of conversation going on around Google and Google search. And so does that then mean that we'll start to see people move over en masse to these other offerings? Google's trying to stop that. What was the big news when ChatGPT came out? Google was caught flat-footed, right? And so they had to rush. They released Bard, which had its own issues at first. Then they renamed that Gemini. They have by the way, Gemini is also a bot that they have, a chat bot that they have that you can do search with. So it has these three disparate elements going on that take advantage of the same models. But AI overview, then you have AI mode, then you have Gemini. They need kind of a more cohesive approach, I feel, and that's what's being offered from some of these other folks.
Dan, switching gears, I want to talk about a court victory potentially for Microsoft in its video gaming saga here. So what's going on there?
Yeah, they've been battling the FTC for quite a while now when it comes to being able to get a hold of Activision Blizzard. They moved ahead with everything. If you look basically at Microsoft, they report as having Activision Blizzard underneath their umbrella, and so it seems as though the FTC kind of lost the appeal here to kind of pull them back from being able to fully own this at this point. And so, you would imagine that it means that now it's kind of over and done with. This was something that was approved from other regulators around the world. And so it's not as though this is something that wasn't already anticipated. But I think this issue with the FTC kind of seeming to go to the wayside, it's just all green lights now for Microsoft.
And Dan, we just got some headlines coming out of Bloomberg, a story that they are reporting here, that the so-called AI diffusion rule will not be enforced by the Trump administration when it takes effect on May 15th. We are seeing a sharp upward move in shares of Nvidia as a result of this. This is being reported by Bloomberg. Again, they are citing people familiar with the matter. They are saying that the administration then plans to rescind some of the AI chip curbs that were put in place by the Biden administration. They are trying to basically change the semiconductor trade restrictions and rules here. And it's not clear exactly what the timeline is looking like. But again, according to this report from Bloomberg, Trump officials are working toward a new rule, they say, that would strengthen the control of chips abroad. So it doesn't sound like export controls would go away, but it sounds like they would perhaps change. And just want to read a statement from the Commerce Department's Bureau of Industry and Security that was provided to Bloomberg by a spokesperson. It says, quote, "The Biden AI rule is overly complex, overly bureaucratic, and would stymie American innovation. We will be replacing it with a much simpler rule that unleashes American innovation and ensures American AI dominance." So again, that doesn't make it sound like we know exactly what will happen, and the Commerce Department is going to enforce the export curbs that exist while they're developing this new situation. But whatever the case is, Dan, this has been something that we know that Jensen Huang, the CEO of Nvidia, has lobbied hard for these restrictions to be removed. So interesting that this is happening now.
Not just Jensen. Some Republican senators have come forward saying that they wanted this looked at and kind of rescinded. The big deal here was that it was going to create 3 different buckets of availability for GPUs. There's first tier allies where they can get what they want. There's second tier users or countries that would need to have licenses to be able to get access to chips. And then there's basically the arms embargo countries that wouldn't be able to get access to this. So it really is something where companies were concerned about this potentially limiting their ability to get AI chips to the right people, limiting AI research, and then on top of that, annoying allies, basically.
To your point, Dan, on that is Bloomberg pointing out, I mean, just in terms of the timing of when this, noting that this is coming as Trump is getting ready to take this trip to the Middle East.
Right.
Whereas they point out, countries like Saudi Arabia, the UAE have been none too happy about the restrictions in place on their ability to get their hands on these AI chips.
Right.
To your point.
It's something that I think has been debated heavily as to whether it's actually something that would work well. Again, the idea of stymieing development of AI. Obviously, there's huge incentive for chip companies to want to do away with these kinds of rules. But then there's the flip side is, okay, does that mean that research abroad and in the U.S., companies that do research abroad as well as in the U.S., are they going to be able to do that, get access to the right people in different countries? So, I think there's going to obviously be, as Julie, you kind of pointed to, there's going to be some kind of restriction. Right. But there was talk of potentially at one point doing each individual country coming together with the U.S. to have their own kind of agreements. That seems like it would be even more onerous. So we'll just have to see what they come up with. Yeah. But I mean, obviously, when it comes to AI chips, it's no longer just about do people want them? It's should people get them when it comes to Washington?
Yes, and really this seems to affect Nvidia more than any other company, this particular rule. Thank you so much, Dan.
Thank you.
A lot to get through there in real time. Well, the Federal Reserve keeping interest rates steady, and Fed Chair Powell highlighting that the central bank's policy is in a good place until further clarity comes amid increased economic uncertainty. For more on how investors can dip into the market post-Fed, we have Vice President of Options at Simpler Trading, that's Danielle Shea, joining us for the Options Pit, sponsored by Tasty Trade. Danielle, thanks for being here. So in the wake of that Fed decision and the press conference, what are you seeing in terms of volatility? What have you been seeing recently? And how should people maybe play sort of the broad market based on what's going on?
Well, the market's still trying to digest what was said today, but overall, I think that the move was largely positive. We're sitting around the highs on the day today, and what's really interesting is that in the options market this week, we've had options traders coming in and buying puts. And so what we're seeing is some short covering. And, you know, when you have a Fed announcement and the news isn't worse than was expected, oftentimes you can get that short covering, especially when buyers come in. So I'm looking at placing a butterfly in the SPX with an upper price target around 5,700 for the end of this week as the market digests this move and trades a little bit higher with that short covering.
And Danielle, you also say for a trade, you like Bitcoin here to the upside. Walk us through the trade there.
I like Bitcoin for a longer term trade. If you look at the weekly chart of Bitcoin futures, what you're going to see is just an absolutely gorgeous trend. It's consolidating. It has pulled back in the context of that trend. And if you throw some Fibonacci levels on there, you're going to see a price target of about $120,000 a coin. So I think that that is a great long-term price target. I'm talking about probably mid-summer-ish as far as that goes. And what I like to do is I like to trade this in the options market. There is an ETF called IBIT that you can trade in the options market that is significantly cheaper, and it allows options traders to get in and trade this ticker to the upside.
And so talk to me about the levels that you're looking at and I know that when you're looking at it, you're not going to do the option on the Bitcoin futures. That goes on IBIT, which is the biggest ETF, right? That's cash Bitcoin, for lack of a better word. So what kind of strategy are you looking at there?
Well, when you look at this ticker right now, it's trading right around 55. And so what I like to do is I like to identify the upper price target. In this case, that's going to be around $65. And so what I like to do is I like to place an at-the-money butterfly. You can also use an at-the-money call debit spread, but essentially what you would do is you would buy the 55 strike and then you would sell the 65 strike because that would be your price target. And then if you want to make a butterfly, instead of just a call debit spread, you would buy another strike equidistant up above. And what that does is it really brings your cost basis down. So for this kind of trade, you can get in for around $2.75 a contract. So that makes it accessible for a lot of different options traders. And then of course, if you have a larger account, then that's when you can increase your contract size.
Danielle, I want to circle back around to the broader market, to the S&P 500 specifically, where you were talking about that sort of potential upside here from there. But 5,700 isn't that far above where we are right now. So I'm curious what you think that sort of longer term trend looks like, given some of the options activity that you've been seeing.
Of course. So for me, it really just depends how far this short covering can take us, because what we really need is we need a catalyst to get us through this area of overhead resistance. The 5,700, 5,750 level is a critical zone of resistance. And what we need is to get up to that zone and then be able to break through it on high volume. So for me, as far as the longer term plan, it depends entirely on if that can happen or not. Because as you know, we have sell in May, go away. That can be a seasonal factor that comes through. We also have major catalysts like Nvidia earnings coming through. However, I am bullish Nvidia, and I love the segment that you just did right before me. So I'm hoping this is going to be a bullish catalyst for the market. But ideally, we can get some bullish catalysts, break through that area of resistance, and continue correcting to the upside and retracing this move that we've had due to all the tariff fears.
Danielle, great to have you on the show today. Thank you for joining us.
Thank you for having me.
And while we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Follow the closing bell. Stay tuned for Market Domination Overtime.